Hi everybody, how are you? This is Mike Andrew, once again providing a short video with practical insights as it applies to business and leadership. I'm going to focus more on the business side today and even more specifically on the finance side, because this is the time of the year where companies have either announced or getting ready to announce their year-end financial results. So when you look at the financial statements, one of the top financial statements is the P&L, or the profit and loss, also referred to as the income statement. And this is where you're going to see companies announcing how they did. So it answers the question, how well did we do? Did we exceed our expectations or meet expectations or not meet our expectations? How did we do this year compared to last year? And how are we doing trending-wise over the past 2-3 years? Are we trending in a positive direction? And how are we performing as it relate compared to our competitors or some of the industry benchmarks? Now, when companies announce their financials, this is pretty important. They have to follow standards, and there's two types of standards. One is Gaap, G-A-A-P, Generally Accepted Accounting Principles. That's what they use in the United States, and in other parts of the world, they use IFRS, International Financial Reporting Standards. This is a must because when companies do their financial reports at the end of the year, the auditors come in and they audit to make sure the numbers are okay and that they follow Gaap or IFRS. So it gives confidence to the marketplace and shareholders and so forth. So it's very important. At a very, very high level, the P&L, in a very simple level, is the total revenues minus total expenses to give you profit, right? Now, companies obviously have to break that down. So what they'll do is they'll highlight the total revenues, and then they deduct from that what's usually referred to as cost of sales. So what are those costs directly associated for obtaining those revenues? And that gives you gross margin. From that gross margin, then companies deduct basically everything else, operating expenses, or OPEX is the big term used today. That's all general selling and administrative expenses, our salaries, if there's R&D is included, all types of overhead and so forth. And then they factor in amortization and depreciation to give you operating profit. In other words, the profit from our operations, what we're in business for. I mentioned amortization and depreciation. We generally know what depreciation is, right? When you buy a car, it depreciates in value. So depreciation is the depreciation of tangible assets like property and plant and equipment. Amortization is the depreciation of intangible assets like patents or licenses or trademarks or copyright or goodwill. Once they get the operating profit, then they deduct separately, what did we pay out in interest for loans and debt that we have? What interest have we earned from some of our investments or money in the bank? And what did we have to pay out in taxes, or in the Middle East, zakat? And that finally gives you bottom line net income. So there's one financial metric that I want to mention because it's pretty significant for a lot of companies, and you may have heard of it. It's called Ebitda. EBITDA, earnings before interest, taxes, depreciation, and amortization. And why is this important? Because for many companies, it's a true indicator of the profit of our operations. How are we doing? Why? Because it takes it discounts taxes that we paid, zakat that we paid, interest that we paid, or interest that we earned, and it takes out of there amortization and depreciation, because amortization and depreciation is a non-cash mechanism. So get it out of there. So it really focuses on the true profitability of running the business, of running our company. And that's why Ebitda is looked at very, very highly. I hope you found this helpful. I'm just introducing this at a very quick and high level because finance is the language of business. Thank you for listening, and we'll see you next time.